Welcome to This Explainer. Today, we're unpacking a truly fascinating stock market paradox happening right now in the 2026 hospitality sector. If you follow the lodging industry at all, you know the dynamics between the companies that own the hotel brands and the ones that actually own the physical buildings are shifting rapidly. So today, we're going to look at a highly specific moment in 2026 where market reactions totally defied surface-level logic. And we'll use this anomaly to figure out the deeper mechanics of how the hospitality ecosystem actually works today. Let's dive in.
We're kicking things off with a mystery. Picture this. Hilton posts what can only be described as a massive earnings beat. I mean, they didn't just meet expectations. They raised their entire outlook for the whole year. And yet, the very next day, their stock tanked by over 5%. Wait, what? Why would Wall Street punish a company for doing exactly what it was supposed to do, and then some? Well, to solve this, we really need to investigate the hidden mechanics of hotel stocks and look way beyond the headlines.
To really understand the severity of this drop, we first have to appreciate just how stellar this Q1 report actually was. Hilton CFO Kevin Jacobs highlighted a 13% jump in adjusted EBITDA, hitting $901 million for the quarter. Honestly, that exceeded the absolute highest end of their own guidance range. They weren't just scraping by here, they were operating with incredible efficiency and generating some serious cash.
Now, the engine driving those massive numbers is a metric called RevPAR, or revenue per available room. If you're going to take the pulse of literally any lodging company, RevPAR is your ultimate health check. And in Q1 of 2026, Hilton saw broad, system-wide RevPAR growth of 3.6% on a comparable, currency-neutral basis. The craziest part? This wasn't just isolated to one lucky region or one type of hotel. We're talking broad growth across all of their chain scales, brands, and segments, right alongside sequential improvement in the U.S. market.
So what's powering all this relentless growth? Well, the foundation of Hilton's success is its asset-light engine. And that engine is fueled by a staggering 251 million Hilton Honors members. Just let that number sink in for a second. That represents a 16% compound annual growth rate since 2012. This massive, incredibly loyal customer base generates predictable recurring booking volume that Hilton can leverage across its entire global network. It gives them an absolutely massive structural advantage.
And you know, that massive loyalty translates directly to future value. Hilton's 2026 outlook is just incredibly robust. Because Hilton operates primarily as a franchisor, meaning they own the brand and the booking engine, not the physical brick-and-mortar buildings, their management and franchise fees, which jumped 10.4% year over year, translate directly into incredible free cash flow. They actually raised full-year EBITDA guidance to over $4 billion and are planning a wild $3.5 billion capital return to shareholders. By all fundamental measures, Hilton is firing on all cylinders.
All right, moving on to our next section, Park Hotels, owning the assets.
If Hilton is the software of the hospitality world, Park Hotels and Resorts is the hardware. They're a real estate investment trust, or a REIT, and they're in the business of owning premium real estate. They actively manage a portfolio of 32 luxury and upper upscale full-service properties, which totals around 22,000 rooms. We're talking about iconic, heavy-hitting assets here, like the Hilton Hawaiian Village Waikiki Beach Resort and the Signia by Hilton Orlando Bonnet Creek. Essentially, they provide the physical spaces where Hilton's loyalty members actually sleep, eat, and vacation.
Unlike Hilton's fee-based model, Park captures direct property revenue. So when you break down how an asset owner makes their money, 60% comes straight from the rooms themselves, but a highly significant 29% comes from food and beverage, with the rest coming from ancillary services like golf, spas, and parking. What this means is that Park's revenue is highly sensitive to on-property consumer spending and operating costs. If food prices go up or labor costs rise, Park feels that directly on their bottom line in a way that Hilton just doesn't.
Now, owning massive hotels requires massive capital, so a huge priority for Park in 2026 is managing their debt. They're heavily focused right now on executing a comprehensive recapitalization, with committed financing already in place to navigate what the industry calls a maturity wall. Simply put, they are proactively restructuring their debt, things like senior notes and property mortgages, to fortify their balance sheet and remove financial risk in a shifting economic environment.
But hey, don't let the debt management fool you. Park's a total cash-generating machine in its own right. They've got a really strong track record of success, having already returned over $4 billion in capital to their shareholders through stock repurchases and dividends since 2017. They are actively managing these assets to squeeze out absolutely every drop of value.
Next up, navigating consumer economic shifts.
Before we can solve our stock mystery, we got to zoom out for a second. The hospitality industry is entirely dependent on the health of the everyday consumer.
Hilton's CEO, Christopher Nassetta, actually addressed a critical economic narrative during their earnings call. He talked about the broadening of the K-shaped recovery. For a long time post-pandemic, the upper-income consumer was thriving. That's the top arm of the K. And they were driving luxury and resort travel, while middle and lower-income consumers really struggled. But in early 2026, evidence suggests this recovery is finally broadening out across the rest of the economy. This is a massive signal for the hotel industry, guys, because it dictates exactly what types of hotels will see the most demand in the coming quarters.
All right, let's look at balance sheets and projections.
To truly grasp how these macro shifts affect the ecosystem differently, just look at the sheer difference in scale between the two models. Hilton's asset-light fee model is projecting over $4 billion in adjusted EBITDA, allowing for $3.5 billion in capital returns in a single year. Now contrast that with Park, the asset-heavy REIT, which is projecting a highly respectable but much smaller NAREIT FFO, that's funds from operations, of between $314 and $344 million. Basically, Hilton captures a small slice of a massive global pie, while Park captures a massive slice of a much smaller localized pie.
Which brings us to the true hospitality ecosystem.
The crucial point here is synthesizing how these two completely distinct models actually work together in the modern lodging industry. They aren't competitors, they're deeply symbiotic. Hilton acts as the asset-light engine. They drive the bookings through their massive 251 million member loyalty program and their global marketing reach. Park Hotels, on the other hand, is the asset-heavy foundation actually holding the physical real estate. Hilton needs Park to maintain beautiful, high-quality properties to keep the brand's reputation strong, and Park desperately needs Hilton's booking engine to fill those 22,000 rooms. Make sense, right?
Finally, let's get into solving the earnings paradox.
So, this brings us right back to our original paradox. If the ecosystem is healthy, the K-shaped recovery is broadening, and Hilton absolutely crushed their Q1 earnings, why on earth did the stock drop 5%? Well, the answer, it turns out, has very little to do with the hotels themselves and literally everything to do with market mechanics. Analysts point to evidence of heavy profit-taking. You see, Hilton stock had been on a massive tear since hitting a low near $230 back in May of 2025. Investors saw the earnings beat as the perfect moment to just cash out at the top. Plus, the Relative Strength Index, or RSI, was sitting in a perfectly neutral 51. That tells us this was a technical repositioning, not a sign of fundamental business deterioration. The market was simply adjusting because Hilton trades at such a high valuation premium, which makes investors a little nervous to hold through a peak. The rising 50-day moving average at $312 offers a pretty logical support zone here.
So, as we look at the rest of 2026 and watch this broadening economic recovery unfold, I'm going to leave you with this question to chew on. Where does the true risk-adjusted value actually lie? Is it in owning the highly valued asset-light brand engine like Hilton, which is clearly vulnerable to valuation pullbacks? Or is it in owning the physical, cash-flowing real estate like Park Hotels, which carries more day-to-day operational risk, but perhaps a much more grounded valuation? The answer to that question is exactly what's going to define the next era of hospitality investing. Thanks so much for joining me on this explainer, and I will see you next time.